I am Andy Finnegan. I'm the marketing lead of the Nebo Wealth team. We're really excited to have you join us today. This is a CFP CE credit approved session. We're going to explore the trends, the methods, and the tools behind modern goals-based investing and how firms are adapting their practices today. And I saw that over half the audience today. It's pretty great, actually. It's new to Nebo. So just a quick word, think of us as a team of industry veterans. We're building tools for what we believe is the next frontier of goals-based investing. And we're a part of GMO. It's a global investment firm. We're in their video room right now, and our mission is to help advisors deliver smarter, more goals-based portfolios that align with real client needs. I'm joined today by two leaders in the space. So delighted that I have Adam Scully-Power. He spent nearly 30 years in the business, 20 years at Columbia Threadneedle, where he built out global investment solutions. He built models for some of the largest firms like Morgan Stanley, Ameriprise, just down the list. And Matt Cadnar, he brings over 2 decades of experience at GMO. He's a senior partner here. He's portfolio manager in asset allocation, and he's led institutional strategies and really helped shape Nebo since day one. So Adam, Matt, thanks so much for joining us. You bring so much depth to the conversation. Before we dive in, maybe just take 30 seconds, say hello to our audience today, and share what excites you most about today's topic.
All right, Matt, I'm gonna take the lead here. So first, thank you all for joining us today. I'm Adam Scully-Power. This topic is near and dear to my heart as someone who's been involved in investments for many decades now. Really at the heart of what we're trying to do is educate the industry around some of these significant trends, in particular this move towards a more goal-centric approach to investing, and deliver tools to allow you as advisors to increase the value of your advice and ultimately deliver better client outcomes. And I think the topic today and the tools that we're going to introduce are really cutting edge, and it motivates me personally every day to get up and help all of you do exactly what I just outlined. So,
yeah, I'm Matt Cadnar. Very excited to talk about this topic. The concept of what's the best way to build a portfolio for an individual is a very interesting one, and it is very different than when you think about building a portfolio for an institution. And this concept of goals-based investing, it's been around for a while now. Everybody seems to know what it is, generally speaking, but it's really ill-defined. And I think the concept of goals-based investing really is in the early innings of some pretty significant growth. And it's really great to be part of the ground floor as we work on and hopefully eventually change the industry.
Thanks, guys. So just to kick it off, just quickly on learning objectives, on the just want to really 3 key things: how goals-based investing is reshaping wealth management by enabling more tailored client-centered strategies. And then we're going to talk a little bit about how the industry is evolving from traditional risk score risk profiling toward more advanced, precise portfolio construction through wealth optimization. And lastly, how modern technology makes it possible to scale this level of goals-based investing across your practice. So it's going to be a lot. We're going to go through, and this is CFP CE credit approved. If you haven't given your number, please shoot me an email or put it in the question or comment box. To kick it off, Adam, can you just set the stage for our audience today? Why is the shift to goals-based investing? We said it's going to double by 2030. Why is it happening now?
Yeah, well, I'm going to start with a survey question that we asked all of you, because I think data is always helpful to kick things off. And we asked, do you see an opportunity to deliver a more personalized goals-based approach to building portfolios? And a staggering 87% of you said yes. And I think we all aspire and work hard every single day to deliver more personalization, to build portfolios around clients' goals. But as we'll outline today, that can be challenging. And so what our goal is to provide you with a framework to think about not just goals-based investing, but a roadmap to really enhance the tools that you have so that you can differentiate yourself in a crowded marketplace, really elevate the value of the advice you deliver, and most importantly, and I said it kind of in the opening comments, and that is to deliver better outcomes to clients. Now, what we've seen for the last couple of decades, we've seen a shift. The sort of core value proposition of wealth management has been, generally speaking, centered around investments, constructing portfolios that seek to outperform markets or benchmarks. And it's really been delivered based on how much risk an investor was willing to take. But that paradigm, I would argue, is shifting. And it's shifting away from kind of a risk-based portfolio construction approach to a much more outcome-based approach. And as a result, what we're seeing is a really significant growth in financial planning. You're seeing advisors move more towards planning to help clients, not just to identify and prioritize their goals, everything from retire to, educate their kid, maybe leaving a legacy. But we've seen a big growth in the planning software that's available. And, like Cerulli calls this table stakes today. They note that financial planning is becoming one of the fastest growing services that are offered by advisors. That's the whole planning side of things. But when it comes to investing, what we hear from firms, both large and small, is that there's a significant disconnect between the financial plans that they're building and the corresponding portfolios that they're delivering. And what we hear is the fact that ensuring clients are in the right portfolio is a challenge. And it's one of the areas that we believe there's an enormous opportunity for firms to improve upon.
Thanks. So, Matt, can you just elaborate a little bit on what Adam just shared? We have some stats, the challenges when it comes to going from a goals-based financial planning world and actual investment implementation to really deliver on the promise of what goals-based investing really should be.
Yeah, just putting some more data on it. So Adam talked about the gap between the plan and the portfolio. 89% of advisors see a gap between the financial plans that they create and the portfolio that is designed to fulfill those financial plans. And the reason why we think that this gap exists is what we've seen some significant advancements in goals-based financial planning over the last 20 or 30 years. Tools like eMoney, Money Guide, Right Capital, they're super slick. They really help the advisor and the client dial out the specific goals of the client. The issue is that on the goals-based investing side, that simply hasn't kept up. We've had some advancements with respect to ETFs and direct indexing, but really the standard bearer for personalization today is the direct index. And that only addresses a slice of a client's overall portfolio. And we know from the academic studies over the last 20 years how the importance of asset allocation in determining client outcomes. But on the goals-based investing side, we just haven't had the same advancements that we've had on the goals-based financial planning. So there's an imbalance. There's an imbalance there. So portfolio construction has largely become more commoditized because it's being driven by risk tolerance, that single input. If advisors want to personalize, they end up having to do it via spreadsheets. It's a highly manual process that leads to spreadsheet hell. It is not a scalable method of growing your business. And then on the flip side, model portfolios are very good in terms of scaling the business for the advisor. But of course, those model portfolios operate independently of the client and the client needs. So for wealth managers, this does create a whole host of different problems, separate and apart from that core problem of connecting the plan to the portfolio. Investment teams and the financial planners tend to be siloed. The investment teams build the portfolio, they basically toss it over the fence. Financial planners are kind of left to their own devices to figure out what's the right portfolio for the client's financial plan. Plans often fail to appreciate unique client circumstances, and clients can lack the understanding of why they own what they own, lacking understanding of the overall plan and the overall portfolio. And then firms will can grapple with showing differentiated value relative to their competitors because they're running very similar processes. It's a little bit like, if you're building a portfolio kind of based on one factor, it's a little bit like walking into a house and telling the difference between a Home Depot flip and a real craftsman kind of artisanal home. And I think it also, for wealth managers, this all leads to an additional problem is that clients are expecting increased personalization. We see increased personalization from every aspect of our lives. I can design my own shoes now, for crying out loud. And so that lack of personalization, that Home Depot flip experience, that can create vulnerabilities, particularly during those difficult times when the markets don't go as planned, or if an individual's life doesn't follow that financial plan, and those difficulties can create vulnerabilities in an increasingly and a marketplace which is increasingly competitive for clients.
Thanks, Matt. I love the 96% stat. That was one of the survey questions that we asked all of you when registration. So our N sample size is over 100 for that. So people know what great advice looks like. It's connecting that plan into the portfolio. So is that the definition of goals-based investing? Adam, I was hoping maybe you can define it for our audience, and then some of our stats, trends. Why does this matter?
Yeah, so how do we define goals-based investing? The trite answer, and the way my kids often try and answer the questions I ask them, they would say something like, well, it's investing based on your goals. And I'd say, yeah. But the reality is it's much more than just that. It's investing that really centers on constructing and managing client portfolios around, yes, the specific client's goals, but maximizing the likelihood of achieving those goals. It moves well beyond trying to outperform the market or some arbitrary benchmark. And I love the image here because at the heart of the matter is it connects financial planning with what we would argue is true personalized portfolio management. And the other thing, importantly, Andy, is it helps keep clients focused on what really matters. So aligning their portfolio with the plan in a very personal, measurable, and I would say responsive way to either changing life goals or changing market conditions. Now, what we're seeing is a huge trend emerging, and that is this trend towards goals-based investing. According to Datos that did a big report last year, today about 38% of advisors do some form of goals-based investing with at least half their clients. I think the challenge in all of this is goals-based investing means different things to different people. So through the course of this event, we're going to walk through some of those different methodologies and help bring some color to that. The number that stands out to me is from McKinsey, and they believe that this goals-based investing trend is likely to more than double by 2030, which really is kind of, we're 5 years away to about 80%. And the question then is, what's driving this? Well, first is personalization. It's transforming nearly every aspect of our lives, from the way we shop to the way we consume media, get our health coverage. So tailored experiences have become what I would argue is the norm. And so it's no surprise that people are now expecting that same level of personalization, that tailored experience in both financial planning and investing. The second thing that's sort of unlocking all of this is technology. It now enables really unprecedented portfolio customization and management, and it empowers you as advisors with tools to elevate the value of your advice, create those tailored solutions, drive more goals-based portfolio construction, and do so in a very, very scalable way. I can share some stats that we put into this around what clients are noting. So Cerulli tells us that 67% of affluent clients rank customized investment solutions as one of the key reasons they choose an advisor. Another one by Accenture showed that 79% of high net worth individuals prioritize achieving life goals over merely outperforming the market. Let me say that again. 79% of high net worth clients, the types of clients that we want to have in our practice, prioritize achieving life goals over simply outperforming the market. The other thing, Andy, that we see And we kind of sit at a very interesting vantage point because we talk with so many firms ourselves as a leader in this goals-based investing movement, is we see firms calling for more robust tools and solutions to help them in this space. Things like when planning isn't connected to investing, it just sort of loses some of its value. We hear things like the gap between the plans that advisors are building and the portfolios they are producing for clients. My favorite one is how one firm noted that it's a race, and they use the term race within the industry to give advisors goals-based tools to build customized investment solutions. And I actually view this as a race, and I think there's going to be firms that embrace and sort of lead and win, and there's going to be a lot that may get left behind. Now, a great way to frame things around this in terms of a race is actually a few quotes here. One is, again, from that big Datos report from last year, all on goals-based investing. And they said goals-based investing has the potential to transform the wealth management industry. And transform is a pretty strong word, but I actually believe it's true, and I think it's going to have significant implications. Capco published a report that noted how firms who decide to implement a goals-based investment process and a solution in this area, they're just simply going to have a significant advantage. And those that fail to act are either going to end up paying more in the end to try and play catch up. And I think that's how we should think about this. Significant trend, here to stay. There's going to be winners and those that are going to be forced to play catch up. And we're already seeing the early evidence of this. And to highlight this is some data out of Orion. We were recently at their conference. And what they focused and highlighted is how advisors who focus on personalization for clients, it's one of the top reasons why advisors grow. And we clearly see this trend firsthand as leading advisory firms that are embracing goals-based investing solutions. They're differentiating themselves, they're driving firm growth, they're providing deeper, more meaningful client relationships. And again, as I said a second ago, I'd argue that firms that fail to adopt a more comprehensive goals-based approach, they simply risk falling behind in an increasingly competitive marketplace.
Thanks, Adam. So this slide on the screen, just a quick story. I remember you and I, we were in Orlando, Florida in February, and this was the slide on the keynote. And a lot of times you look around in the audience and people are either scrolling on their phones or maybe they're taking some notes. But when this slide came up, it was almost like back in the day, Super Bowl kickoff, when everyone took out their phone or you saw the flash photography. People were taking pictures of this slide, and it became a little bit of a butt. It was a nice aha, because the buzzword you see everywhere is personalization. But how does that lead to not only better outcomes for the client, but better business value? So this was a big talking point, and the last couple months, it's been everywhere. Maybe just to transition, that was awesome, by the way. That was so good on trends and stats. One of the things that I really also like about goals-based investing is there's just this behavioral finance component. So the importance of knowing what you own, why you own it. Matt, do you have any stats or any stories to quantify that?
Yeah, I feel like this chart is the flip side of the chart that Adam just showed you on why advisors are focusing on personalization. So 98% of advisors say that clients who understand, who more likely to stay invested when they understand their portfolio and how it supports their goals. Like, honestly, I don't even know what the 2% that said no were even thinking. I'd actually love to kind of interview them and see what the rationale. But and this really gets to the heart of why this matters. And it's understanding this trade-off between understanding and emotion and decision making. And Ray Dalio from Bridgewater has a great chart that talks about when your understanding of anything is low, your emotions tend to be high because there's uncertainty, it's scary, there's fear, there's doubt. All of those emotions play on us, and that leads to poor decision making. But as that understanding increases, as you understand the why you own what you own, why your plan is the way it is, as you increase that understanding, that emotion drops. and you're able to make much better decisions. And I think that's exactly what you see with this second set of studies. So SEI did a fantastic study about clients' reaction to the 2008 financial crisis. So the worst market we've seen since the 1930s, and 75% of clients with a goals-based approach made no change to their portfolio. They were able to weather the storm, the worst storm in 80 years. But half of those clients with traditional investment portfolios, traditional processes, fully liquidated their portfolios. And this, frankly, is tragic. You have a client's portfolio down 30, 40, 50%. They sell at the bottom. Expected returns, the stock market just got whacked in half. Expected returns increased dramatically. Stocks are the cheapest they've been in for a generation, and they're out of the market. That is a permanent impairment of capital. That will significantly impact the ability for that family to retire or pay for their kids' college education, do the things that they need to do with their assets. And so I think that's why this is so critical, this understanding and portfolio construction that's based on your goals and understanding those goals. I think that's absolutely critical. But the getting to this point today, it's been 60, 70 years in the making. So we have modern portfolio theory. Harry Markowitz in the 50s talks about maximizing return for a given level of risk. Now, how he defined risk is really critical. He's an academic, so he defined risk as volatility. That does a great job for equations, but it's not real world risk. And then the 80s comes along, and economists, behavioral economists start to understand that people are not entirely rational. They make irrational decisions all the time. Trying to understand that better. Folks like Kahneman and Tversky, George Akerlof, Colin Cameron, really helped advance this decision making and focusing much more on outcomes. And that leads us to where we are today of goals-based investing. And that really has been driven by this creation of the goals-based financial planning tools that I talked about before. But the theory, unfortunately, is ahead of reality. That goals-based investing heretofore really has been time-consuming and not scalable. And that's what we're really here to talk about, and what we're really here to solve. So that goals-based investing, can really run the gamut. So there are practitioners that kind of give it lip service or marketing aspect to it. That's the key for them. But then there are also folks out there that really view goals-based investing as a foundational value proposition. I think one of the things, and Adam alluded to this earlier in his introductory remarks, there's no standard definition of what goals-based investing is. Everybody kind of understands what it is generally, but there's not reams of papers from the CFP or the CFA Institute on the topic. So it's a little bit of an open field, and it's definitely ill-defined. And I guess you could ask a quite a simple question, like, isn't all investing goals-based? And the answer is absolutely. Whether you're an individual or institution, everybody has a goal in mind. The issue is that the prevailing portfolio construction paradigm out there is really based on risk. And so just talking a little bit more about the risk profiling approach. So kind of the simplest description of this is a client comes into your office, you put together a big, beautiful financial plan embodying all the client's hopes and dreams. You take that financial plan, you set it off to the side, give the client a risk tolerance questionnaire. That risk tolerance questionnaire is translated into a risk score. And then what we see most often is mapped to a model portfolio, generally the moderate portfolio. Then the advisor may or may not run some simulations to see whether or not that plan and that portfolio pass some arbitrary threshold, but it's not best or it's not optimal. But most importantly, the worry here is that portfolio, that plan, is not connected. That portfolio is not connected to the financial plan. It's connected to the risk score. So if your goals and objectives change, the portfolio doesn't change. The only way the portfolio changes is if that risk score changes. And I think that is a big detriment to this approach, this focus on building a portfolio based on a single risk factor. And two simple illustrations of that. We have two clients, a younger client making less money, saving less, 85,000 investable assets, and a more modest goal for retirement. That client gets a risk tolerance questionnaire and it gets mapped into the moderate model. Now look at client two. client two is much older, their time horizon is much shorter, they have more current income, they have savings more, they have more investable assets, they do have higher goals, but that is a very different set of circumstances. And yet, when the risk tolerance questionnaire is given to this client, he answers it the same way that client one did, and they, lo and behold, they get mapped into the moderate model, the same portfolio, because of the risk tolerance questionnaire. All of the other different elements are incredibly different, couldn't be more different. And the number of firms that have told us that they have 90% of their clients in the moderate model, I mean, the N is bigger than one there. And that is I think that's a concern for those firms. And frankly, I also think it's a compliance risk as well, because you have very different people with very different situations, all built into the same portfolio. And this is not, we are not saying anything dramatically new. I think advisors generally get this. So we had another questionnaire question. Do you think risk questionnaires reflect the client's true risk preferences? And the answer was no. They recognize the vagaries, where those risk tolerance questionnaires fall short. If you're in the middle of a bull market, people have much higher tolerance risk than they do in a bear market. And then they also recognize that the risk scores shouldn't be the main factor in building a portfolio, despite the fact that many do use risk scores as the main determinant portfolio. But they recognize that it's more of a mosaic approach, that it is based on an advisor's intuition, which can be honed over a number of years. But I think the issue is that, by and large, advisors lack a proven, repeatable process, a goals-based process that's integrated and differentiated relative to what others are doing out there. And so in summary, we get it, right? The risk tolerance questionnaire, it's simple, it's easy to communicate. You might be able to argue that it's actually too easy to communicate, so therefore it is undifferentiated relative to your competition. I think it's mostly defendable from a compliance perspective. I used to be an attorney way back in the day for a broker-dealer, so I have some understanding of that. And I think quite powerfully, it's status quo, it's inertia. The issues on the other side, I think, are pretty significant. It's not, the portfolio is not connected to the financial plan. It does not take into account time horizon. All of the uniqueness of that client is lost. And I think ultimately, it is a process that is not differentiated, and clients know that on the other side as well.
Thanks, Matt. That was just to kind of take a pause. I saw a couple new audience members entered the last 5-10 minutes. So welcome to today's webinar on goals-based investing. Right now, we're in the learning objective number 2. This is where we're just covering the evolution in the history of goals-based investing. Matt just talked about kind of that first stage, which is the risk profile approach. For what it's worth, when we talk to industry experts and the folks that do goals-based investing, they say 90%-ish ballpark use the risk profile approach just to quantify the popularity of it. Adam, I was hoping next you can talk a little bit about that next level of goals-based investing, or the next phase. I think I remember in my CFA level 3 textbooks reading something about risk bucketing or mental accounting, something like that.
Yeah, thanks, Andy. And Matt, great job. I mean, what risk bucketing is doing is really building upon the sort of simple risk profile approach. And when I mean building, it's adding slightly more structure and purpose to the allocation decision. So instead of just simply viewing risk kind of like solely through the lens of emotional volatility, what risk bucketing does is categorizes assets based on specific goals. So at least the goals are now incorporated into the process, whereas risk profile generally does not. And so it's bringing in the goals. It's also bringing in some element of time horizon or time frame. So for example, you might bucket near-term needs such as upcoming expenses into bucket 1. They tend to be allocated to safer, lower volatile assets like cash, short-term bonds. Conversely, in bucket 3 for long-term growth, things like retirement that might be 20 years away, that could hold riskier, higher return investments like stocks. Now, as risk bucketing grew, and where it really, Andy, came out of, and you referenced behavioral finance, is risk bucketing actually came out of behavioral finance, in particular, this whole concept of mental accounting. And what that is a tendency for people, they find it easier to separate their money into different buckets or groups in order to account for where it is and how it's invested and what's allocated to save or spend, depending on the labels we might give it. So risk bucketing has really taken hold. And maybe a really good example, I think, of risk bucketing that we all probably know pretty well is retirement target date funds. We've all heard the framework of a simple glide path approach to a target date fund, but that is essentially a streamlined form of risk bucketing. So in this example, what a glide path does is it treats the investor's entire portfolio as something that moves through a time-based kind of risk bucket. So early on, when we're a long way away from retirement, the portfolio is, quote, bucketed for growth. So it tends to hold more equities to capture higher long-term return opportunities. And then as time progresses and the retirement date nears, the glide path automatically shifts the portfolio to a more conservative bucket or conservative stance, increasing bonds and reducing equity weight. So I think the glide path is a good example, quite popular in particular in the retirement space, of a risk bucketing approach. And recently we put the quote in here. I had the opportunity to be on a podcast and we were talking about it. And Jason Piera, who's the host there, he was said that glide paths do a really good job of creating a better default, but it absolutely does not meet the underlying needs of the individual unless you just happen to be in the exact cohort that target date fund matches up to. So if I were to kind of summarize the whole risk bucketing approach, kind of level 2, moving beyond risk profiling into risk bucketing, it definitely improves upon that simple risk profiling approach. It's relatively easy for clients to understand and see visually. It incorporates time horizon into the equation, which is important. And it can help clients stay kind of emotionally invested during volatile markets because they know they have that bucket 1 with sort of safe conservative assets. But I would argue that this type of approach, generally speaking, introduces some operational complexity. You have to have different accounts for different buckets. You have to account for each of those. It can also lead to what I would argue is inefficient asset allocation because you can have duplicate exposures in the different buckets. And when you have lots of different goals, juggling those different goals across different buckets makes it hard, cumbersome, somewhat complex. And for advisors who are trying to grow and scale their practice, it tends to be a relatively difficult one to scale. Technology is helping some regards on this, but I'd say in the quote good, better, best, risk profiling is a good starting point. Risk bucketing is a little bit better, and maybe it's time we transition into what we would argue is the third in that evolution.
Thanks. That was super helpful. And I would say in terms of best, or I'm thinking about how do we unlock true comprehensive goals-based investing? Many advisors we talk to, they're looking to deliver something that's more precise. So that what we believe is the gold standard, that level 3 of goals-based investing, wealth optimization. Matt, can you take it from here and just kind of educate how we think about it?
Yeah, I think of wealth optimization, it's the whole enchilada, right? You have the client's goals, you have the cash flows, you have the time horizon, you have their legacy wishes, and you have, importantly, you have risk tolerance. So I talked about risk tolerance before, and the difficulties, the drawbacks of risk tolerance, but that was in context of constructing portfolios. Risk tolerance in and of itself is critical. That's the 50% of those folks who sold out in the bottom of 08. That didn't have the risk tolerance correctly calibrated. And so the wealth optimization approach is going to balance all of these factors. It's not going to build a portfolio based on one or two factors or some type of mental accounting. It's going to take into the totality of the client's unique needs and circumstances. And so with those goals, those cash flows, that time horizon, we can create a wealth benchmark that is completely unique to the client. And the wealth benchmark are the dollars in the client's checking account, that, the amount of money they need in order to achieve the totality of all of those goals throughout their financial journey. And in the wealth optimization, risk is not volatility. Risk is a characteristic of the portfolio. The volatility is a characteristic, but it is not the sine qua non. It's not the essence of risk. Risk in the wealth optimization framework is falling short of that wealth benchmark. Risk is not having the financial resources you need when you need them. And so this is I would argue this is a less academic, this is a much more intuitive and a much more practical approach to thinking about risk and therefore building portfolios. And the process is really focused on maximizing the likelihood of goal achievement, making sure the client stays above that wealth benchmark, minimizing the impact if things don't go according to plan. And then if that plan changes, the wealth benchmark changes, and then the portfolio changes on top of that. And then throughout all this, maximizing the likelihood that you achieve your goals, minimize the likelihood of falling short. Part of that is building a cushion or financial surplus to maximize the likelihood of achieving your goals as you go through that financial journey. So how this works is we go through a process of discovery, and that is related to the cash flows and the specific goals for the client. And so you can use eMoney, Money Guide, the financial planning tools, or you can use some type of light approach financial planning. But you need to understand what those clients' goals are in order to map that into the wealth benchmark, which really represents all the goodness, all the uniqueness of each client. And then we run a complex optimization to build a portfolio that maximizes the likelihood that you stay above that wealth benchmark through time. One of the things that I think is absolutely critical about this process is that it's dynamic. If the portfolio changes, if your plan changes, your portfolio is going to need to adjust relative to that new plan. Now, we know that clients' lives are dynamic. We know that markets tend to be dynamic, but so it's incredibly important to have a goals-based process that responds to those dynamisms as well. If you think about it this way, if a client inherits some wealth, now they have more wealth than they need in order to achieve that plan. So if their goals don't change, their money has their expected return, or their return necessary in order to achieve that plan, will actually go down. That money doesn't need to work as hard because there's more of it. And now we've all been taught to rebalance back to the static allocation through time. And so if you do that in this particular circumstance, you're going to be taking more risk than you need in order to achieve that client goal. And so that's the beauty of this process, where you re-optimize based on the new goals, based on the new circumstances, to make sure that the portfolio has the right risk alignment relative to those client goals. And I think that this process, this is certainly what we hear from NEBO advisors, this process has helped change the nature of the conversation with clients. It's less about things they can't control, like the market or what the Fed is going to do, and it's more about the plan and the things that are within their control. And that is really helping the clients understand the why. We talked about the importance of that before, and it's really changing the nature of the dialogue between the advisor and the client into a much more stable, long-term, appropriate ground.
Thanks, Matt. So this is my favorite part of the presentation. This is where we're going to introduce a case study and really breathe some light and make this more concrete. So Adam, I'm hoping you can make this, I think we have a case of Sarah and James, a nice young couple looking to solve some goals. So maybe if you can run us through.
Yeah, let's take and expand upon what Matt just introduced, and that's the goals-based process through wealth optimization. So we have a couple here, Sarah and James. They're in their mid-40s. They've got 2 kids. They want to retire in their kind of early 60s, and they have a number of really important goals. Number one is they need to fund their kids' college education. They need to save and accumulate enough money to retire comfortably. They'd love a vacation house at some point. Maybe that may be a little aspirational, but it's one of their goals. And if possible, they'd like to leave a small legacy to their kids. So that discovery phase is all about what matters most, and we capture that there. Next, what we have to do is we have to align their goals to, as Matt just detailed, their personalized wealth benchmark. And in essence, what that is, it's a timeline of how much wealth that they're going to need at every single future milestone in order to achieve their goals. It becomes like the base case, if you will. And so that wealth benchmark, I would argue, is the unlock to deliver true goals-based investing. You can think of it as a kind of dynamic, forward-looking target line that shows what the client needs in order to be above the minimum level so that they stay on track and they maximize the likelihood of goal achievement. And it's also, Andy, that wealth benchmark, I would argue it's the thing that changes the nature of client conversations, kind of moving away from how am I doing relative to the market to am I on track to meet my goals? And as we'll talk about, show progress towards those goals. So we start with the wealth benchmark. We can see it here. We also plot for them what their projected wealth might look like over time. And then from that wealth benchmark, we're able to run some advanced optimization. And the objective of the optimization, this wealth optimization process, is really quite simple. Matt outlined it earlier. Number one, we want to maximize the likelihood that the client's wealth stays above that benchmark throughout their financial journey. And at the same time, what we're seeking to do is minimize both the risk and the severity of falling below it. So it's sort of like a dual mandate, a dual function. We have to grow the portfolio to stay above that minimum and also minimize the risk of falling below it. And what that does is it helps create a plan that's resilient, it's realistic, and it's inherently personalized to the client because every single client's personal wealth benchmark is unique to them. It harnesses and captures all their goals, all their needed cash flows in the future, all their time horizons, and it allows clients to move forward with confidence. And that portfolio that gets generated can be built upon almost anything. And that's one of the things that I love about this approach is that it's open architecture. So it can be built across traditional asset classes, alternative asset classes, even private markets, and it can be implemented using kind of almost any investment vehicle, from mutual funds to ETFs to individual securities and the like. And what that does, it allows firms to maintain their kind of unique investment philosophy. So one, we have the option to create a very personalized bespoke portfolio, but what you see here on the screen, and this is something that we are really, really excited about, this wealth optimization approach allows for a optimal model selection capability. And let me explain a little bit about what this is. This allows you to take your firm's models. You could take your home office models. In fact, you could take the entire model marketplace that you might use. We can map that into this process and use the tools to align the client's goals through their wealth benchmark to the optimal model or blend or combination of different models from a model marketplace. We think this is the next generation of the model marketplace. We actually met with Cerulli the other day, and they concurred. It's goals-based optimal model selection. And at a high level, I think, Andy, what this does is it helps solve the very challenge that we discussed at the very, very beginning of this session, and that is ensuring that clients are in the right portfolio. So one of the things we hear all the time from firms is there's just too many models. They were originally designed to make things easier. Ironically, they've actually made it more complex given the sheer kind of explosion in number of choices out there right now. So it's really hard to efficiently select the model that best fits a client's goals. Where this was really captured for me personally, where we were at a recent CEO conference and someone was speaking, and it was sort of an off-the-hand comment, but it rung home. And he said, the single thing that all of these model portfolios have in common is they know nothing about the client. Let me say that again. The single thing that all of these model portfolios have in common is they know nothing about the client. Maybe they have the client's risk tolerance, which is how they choose the portfolio. And so what we're really trying to do here is change the nature of that comment and create tools so that we can bring in and incorporate everything that's unique about a client, create that personal wealth benchmark for them from which we can optimize and either build a very bespoke portfolio or select the optimal model from a huge array of choices to ensure the client's in the right portfolio, they're on track to their financial goals, and ultimately improve investor outcomes. And it's a really exciting time to be in the industry. And I think we're on the verge of firms really taking this opportunity by the horn, if you will, and moving the whole industry forward.
Love it. Thanks, Adam. I would say the too long didn't read up to this point is, how do we better connect goals to models? That's what we hear at all the conferences. How do I better connect the goal of my client into the appropriate model portfolio? Now, Matt, would you say that that's set it and forget it and one and done? Is there an evolution? Clients' goals might be dynamic, markets are dynamic. And then once you decide on that optimal selection, even if it does evolve over time, how do you report back to the client that things are going to be okay or the strength of their plan?
Yeah, one of the big strengths I think of this wealth optimization process is it does give you a process for evolving the portfolio through time as any one of the key elements of the financial plan changes. So in this example, if the client is on track the entire time, but their time horizon is shrinking, the portfolio should adjust. And I think sometimes what we hear from advisors is they struggle kind of moving from one model to the next. Sometimes it's very obvious, but there can be a lot of nuance in that. And having a goals-based process that is systematic, that can help the advisor think about the right model, the right portfolio, given a new, unique change in circumstance, that's definitely what this very dynamic process can allow. And so as a result, reporting needs to adjust with that as well. Now, when we look at financial reports from the leading financial planning tools, they all talk about the probability of success, which is defined as do you run out of money at some point? Now, that's relevant, and if your goal is to die with zero, that is very relevant, right? That is your goal, and that is reporting on how probable it is to achieve that goal. But if you have legacy wishes, bequests, if you're not comfortable dying with zero, you want to build a little cushion in there as well, your goals change. And so instead of focusing on simply that blunt instrument, are you going to run out of money or are you not, which doesn't distinguish between whether you miss by $1 or whether you miss by $1 million, focusing on the probability of goal achievement. Like, we spent all of this time building these financial goals. We need to report on them in a more robust way to help, again, getting back to that understanding for clients. And then we've created something we're calling the Plan Confidence Index. And this is a measure of how resilient the plan is relative to the goals. And the whole point, again, is to focus on the goals to maximize the likelihood that you achieve them and minimize the likelihood and severity if you do fall short of those goals. And so reporting becomes a critical piece in increasing that client understanding. So in summary, with wealth optimization, we really do believe that this is true personalization, that this is a leap forward for the industry relative to risk bucketing and certainly relative to risk tolerance as a portfolio construction methodology. And I think this process helps the goals-based investing catch up to the advances that we've seen on goals-based financial planning. So they're much more on equal footing relative to the last 30 years. Now, this obviously, it doesn't, there's limitations as well. So you need to get data. You need to have the client's goals, cash flow assumptions, and whether or not you import that from financial planning tools or use the like financial planning tools, you need to have a concrete understanding of those cash flows. This is technology dependent. This is really an advance that wasn't available several years ago because of some of the technology that is now available to us. And it's not, the mathematics behind this is not AI, it's actual calculus and some pretty advanced calculus, but it is dependent upon technology platforms in order to deliver it because the calculations are significant. And then lastly, that communication tools, those reports really do become critical because if you don't, if you're just talking about something in the abstract, that becomes difficult to understand. That does create more emotion and fear and uncertainty. And so having good communication tools really become important in terms of how you can materially change those client conversations.
Thanks, Matt. So just for sake of time, I'm just going to recap everything, hopefully in a little bow. We'll talk a little bit just about how Nebo Wealth, we are a portfolio construction engine or tool that can help you deliver on this wealth optimization. But just to recap, so risk profiling, it's awesome at scalability and efficiency. Where it falls short a little bit, in our view, is just personalization and alignment. So a little less precise. Now, risk bucketing is a better approach, but again, that has you give up some of the scalability and some of the efficiencies. And what we would argue unlocks true comprehensive goals-based investing is what we just did the whole case study on, which is wealth optimization. We think you get that high degree of personalization, alignment, scalability, and efficiency. And just Adam, Matt, I think we should add something under approach for difficulty, because wealth optimization sounds great, but Matt, you just covered some of the cons. And the way I think about it is, if you go on a new training or exercise program or a new diet, it's upfront work that you have to put the work in, but we believe that the benefits are going to be worth it. And with wealth optimization, that's kind of how I view it. So maybe a little bit, Adam, if you can go next. We have a slide about just why goals-based investing matters in terms of telling a better story to clients, and then we can wrap it up with a little bit about Nebo.
Yeah, thanks, Andy. I love this slide here because what we're really getting at is this idea that goals-based investing is changing the way that all of you as advisors engage with clients. It allows you to talk differently, where you lead the conversation with clients around their goals instead of just products. It allows you to invest differently, moving beyond kind of a one-size-fits-all approach and tailor investment strategy that is truly aligned with client goals. And importantly, and I think we're going to see this increasing over the near term, it allows you to report differently. And that's where client reviews show progress towards personal goals instead of just how are we doing relative to a market or some arbitrary benchmark. Collectively, what this does is it elevates the value of the advice you're delivering. It keeps clients engaged in what matters most to them, and that's the whole nature of their goals. So we see this as a huge trend, and we're excited to be at the forefront of it and be a collaborative partner for all of you in helping not just the industry move forward, but you and your firms move forward to better serve clients.
Thanks, Adam. And Matt, I'm hoping this is probably unfair, but if you can do this in 3 minutes or less, the next 3 or 4 slides, and then we can just wrap it up.
No problem, Andy. So Nebo, so kind of stepping back for a second, what is Nebo? Nebo is a leader in goals-based portfolio construction. So we have an advanced portfolio construction engine. We use our proprietary wealth optimization, which shouldn't be a shock at this point, our wealth optimization tool. And it really is at the cutting edge of goals-based investing. And we provide the goals-based infrastructure to effectively execute on goals-based financial planning. Again, I think of us as the layer that connects the plan to the portfolio through our wealth optimization, our personalized wealth benchmark, personal portfolios, kind of UMA, personalized unified managed account, or unified managed household, or optimal model selection. The very flexible. So we've won some awards, which is fantastic, all around portfolio construction, industry disruption, doing new things differently and better. We've had some very high praise from other folks in the industry. We're relatively modest folks. We wouldn't call ourselves the holy grail of portfolio management or the best platform there is, but if somebody's going to describe you as that, I'm happy to read those words, and those are all from folks that have been around the block. But lastly, and just to finish, this is probably the thing that we're most collectively proud of. We surveyed the NEBO advisors as to the benefits that they see from NEBO and the clients, and 94% view that NEBO elevates the quality of their advice. It improves the quality of advice. It boosts the confidence in the investment process. They have greater confidence, 85%, in the investment plan. That, I believe, leads to greater trust. 87% believe they now have greater trust with their clients through the NEBO, through this wealth optimization process. This, in turn, helps them position the firm for growth because now they have a differentiated approach, a true goals-based approach. And then lastly, the whole reason why we're in this, 83% believe that it improves investor outcomes. And we do believe that the evolution from risk tolerance questionnaire to risk bucketing to that full wealth optimization is a dramatic leap forward for the industry, and we're proud to be a part of that.
Thanks, Matt. You crushed it right on time. So I'm glad we're going to end on time. So if you'd like to learn more, feel free to scan the QR code, go to our website, nebowealth.com. You request a demo, you'll meet one-on-one with Adam or Matt. They'll be able to chat with you. We're also looking to do a pilot program or two. If you're with an advisory firm, in the summer months, we would absolutely love to discuss what that would look like. And, one takeaway for me, if you can in the goals-based investing movement, we'd like to be leaders on it, and we're welcoming you and other advisors at your firm. Please forward our story along and with us. And I hope you all have an A+ summertime, whether that's vacation, time at the beach, the lake, walking your dog. I'm most forward looking to taking my 2 kiddos, 2 years old and 6-year-old, to the Boston City playgrounds, shooting some baskets, and going to Jersey Shore on the beach. So I hope whatever that is that gives you peace and recharge in the summertime, you get to find it. And thanks for joining us.